for measuring the default risk. Initially, I will talk about structural based models. Structural based models typically the most common form of that structural based models is a Merton model. So we'll try to discuss a little bit more on this Merton model. Then we talk about a brief into the credit scoring kind of models, and then we try to understand the various the various classification mechanisms. How do various models classify a particular firm into default or non-default kind of category? What are the various mechanisms that are being used in those things? And finally, trying to understand some of the trade-offs and what are the various factors that we consider in the choice of the model. So these are some of the things. Of course, not too much of numerical calculations involved in them, but trying to understand the quantitative methodologies that are available for the computation of the default risk. So let's get started. The first of them is the structural based models. When I talk about the structural, they look at the structure of the balance sheet. They look at the capital structure. Based on the capital structure of the firm, means based on the debt as well as the equity structure of the firm, they try to compute the probability of default. Though that's the reason they are called as structural models. Based on the understanding of the value of debt and the value of equity of the firm, which combined together will form the value of the firm, based on them they are used to compute the probability of default, because default is more associated with the inability to pay the interest and principal on debt. So based on this value of debt, or probably what proportion of the overall value of the firm is the debt, so based on those kind of aspects, the probability of default is computed. And if we understand a little bit more in detail, whatever is the value of the firm, right? If it means that probably if the firm is getting liquidated, this is the amount that the firm will fetch. If it has to sell off, this is the amount that it will fetch, out of which the value of debt, the debt is the amount which the lenders, whatever the amount they have lent, they would be taking that, and whatever is the remaining amount, that would be going to the equity investors. So let's say if the value of the firm is $100 million, and probably the loan that has been taken is to the extent of 80 million, so then the remaining 20 million goes to the equity investors. But in the same example, if the value of the firm came out to 70 million, then the debt investors will take only 70 million and the equity guys will get zero, because equity has the last claim on the value of the assets, and the debt investors typically have a fixed claim. So unless the value of the firm, if the value of the firm goes lesser than the value of the debt investors will get all the value of the firm and the equity investors will get nothing out of it. Means though they have to get 80, but because the value of the firm is only 70, they are going to get only 70, means they are absorbing a loss of 10 million. But in case the value of the firm is higher than the value of the debt, obviously they are still going to get their value of 80 million itself, means the remaining 20 million will go to the equity investor. So here we are seeing that the payment to the equity investors is more like a contingent claim and somehow resembling a call option position. If we just evaluate this or look at it a bit more in critical, this is suggesting a call option position on the firm, the call option on the value of the firm with a strike price equal to value of debt. When I look at the payment to the equity investor, it looks as if, see, if the value of the firm is less than the value of the debt, the equity investor is going to get 0. If the value of the firm is greater than the value of the debt, he is going to get the difference. This is exactly similar to the payoff on